Hey guys, welcome back to another video. So I know we always talk about a bull market, boo, just keep buying. But today I want to shed some light or to at least throw some caution into the wind when it comes to investing in alternative markets. Today we're going to be talking about India especially. So we're diving into the Nifty and the Bank Nifty indices, talking about some key stock moves and take a closer look at the ongoing market drop to understand what's really going on. I'm going to dive deep into the Nifty 50 index, which is their top 50 Indian companies. But the last few days, everyone's probably thinking that the market was going to be bullish, right? Because we've fallen so much and all the Nifty 50 has been doing the last couple of years has been going up. But as we saw, things have been taking quite a different turn. I know it can be frustrating to explain that stock moves can go down and people might not understand or want to listen, especially if you're a dumb bull. Not saying bulls are dumb, but for those who are logical, let's break it down. Yesterday, the news was abuzz with talk about the Prime Minister Modi's suggestion to invest 50% of your money in the stock market. That is quite a ludicrous claim for a Prime Minister to say, but I get what they're trying to do. They're trying to revive confidence in the market and also to increase retail investors' belief in the market. But the message seems to be rooted in something Mark Mobius once said. So let's clarify, who exactly is this dude? Who is Mark Mobius? He's just a billionaire from the US who mentions allocating 50% of his emerging market fund to India and China. And they are just reiterating and regurgitating this out in India quite a lot. So I'm not trying to stir any xenophobic sentiments, but let's be real. Just because some foreign billionaire says something, it doesn't mean it's gospel. In fact, they could be feeding you praise just to use you as their exit strategy. Trading your validation for your hard-earned cash while they quietly slip out the back door. It's happened before and it'll happen again.
Of course, India would have to come first. And India, of course, has the brain power.
So, don't fall for the hype just because it comes wrapped in a foreign accent. And I think that's the danger, because if you're uneducated and you see some white foreigner that, they have a lot of stock market success telling you that this is going to happen, you tend to want to believe them because of credibility or the hype or whatnot. But some of it might not really be true. And what Mobius also said was that since people are not comfortable investing in China due to government controls and the difficulty to get capital outflows, so it's difficult to move money out of China. That's what Mobius actually said. He wanted to shift his focus to India. And now this whole invest 50% message is being plastered everywhere. But I think it's being taken out of context. The real message is that Mobius was talking about putting a percentage of his fund and his savings, not exactly throwing 50% of their entire income into the stock market. Think about it, for example, people in India don't really make a lot. And let's say they earn 100 rupees. Taxes take away 30 rupees, and now they're being told to invest 50% of what's left. The math simply doesn't add up. Investing and saving is important, sure, but there has to be some logic behind it. Pushing this narrative of continuously DCing into a market that is overvalued is misleading. If you look in the price to earnings ratio of the Indian stock market right now, it is indeed valued as expensive. So why am I cautious about the Indian stock market, particularly the Nifty 50? For starters, there's been a surge of new inexperienced investors entering the market with the hope of making quick cash. So I like to do this thing called social listening. A quick scan of social media sentiments show many don't have the risk tolerance needed to handle even a minor correction. You look onto X or Reddit and you're looking at people talking about a market crash when it's simply just a 7 to 10% correction so far. And that's worrying. India is trying to be more self-reliant, reducing its dependence on foreign investment. But as of September 2024, foreign investors actually don't really make up a lot of valuation in the Indian stock market, accounting for only about 16%, the lowest in a decade. So foreign institutional investors, particularly those from Canada, if they decide to pull out their $45 billion, the Indian market could still face serious consequences because of the trickle-down effect and the liquidation cascade, because a lot of it is driven by sentiments. At this point in the market, it's already overvalued, and a lot of new entrants that are purely sentiment-driven. So if they lose confidence, they're also going to cash out quickly, like what's happening right now. Today, or the last few days, the market opened with a little bit of a relief rally. It went from 2467 to 25226, and now it's trending back down below 24,000 on the Nifty. So the Nifty has dropped over 500 points, the Bank Nifty by over 1,000 points, and a lot of other indices. So the Nifty has dropped over 26,300 to 24,000 at the lows already. So that's about 1,300 points. And other indices also saw significant losses. More than 100 stocks in the Nifty 500 have corrected by over 20%, with some falling as much as 50%. So it shows that the broader market is hurting, even if the Nifty hasn't shown the full extent of the damage. Drawing some parallels with the US stock market, you can see like their Nifty 500 is kind of like the S&P 500, the Nifty 50 is kind of like their QQQ top 100, but the Nifty 50 is just 50 instead of 100. So what's the takeaway here? With these two markets that are overvalued, it's best to stay cautious. If you're trading, you need to be mindful of key levels. So watch this 2400 level. It's a very serious support level. We call this the point of control. If we reclaim this level and sustain it over here, there could be upward movement. But if we break below, I expect more downside. Technically speaking, the market has no real strong support down below. Fundamentally, while India has a lot of potential, it's still a long road before it cements itself as a global powerhouse. These kind of takeovers, if you're talking about the global system, takes time. Right now, US is still the global powerhouse, accounting for 60% of the market cap, I've said before. But I think China and India has potential in the long run, which is why I've also said I'm trying to diversify into alternative investments into other countries like Vietnam, China, and India. But I'm looking for good key price levels still. So if you're a long-term investor, I would say don't get carried away by the noise. Always have a solid strategy in place. Of course, I'll be a buyer of US stocks and Indian stocks when they reach fair valuations. And you might be thinking, it's expensive now, it's been keep going up. But just to let you know, they do correct. There's this thing called gravity. And if you look at 2008 and 2000, that's when US stock market actually, from overvalued, went to close to fair value. It's never been undervalued. And the only one that's undervalued, I would say, is China and Vietnam. So it's important to look at some kind of fundamental analysis still. As much as you want to say Benjamin Graham's Intelligent Investor and fundamental analysis doesn't make any sense. As always, I wish you the best of luck in your investing and trading. Do remember to like, share, and subscribe. Leave a comment below on what you think, and I'll see you guys next time. Bye.